Hey guys, so I wanted to get you guys started. So this is we're going to be in the Red Book, and this first chapter is kind of like the review. So they talk about assets again, liabilities again, owner's equity. So hopefully you can see my screen. This is a whole new, I'm trying to use Studio. So let's see, let's go on to the next slide. So like I said, we're going to talk about departments. So before everything, all of our sales and all of our items that we purchased and stuff were in one category. So that's not the case. So we have different products that we sell, and so we have different departments that we're going to be using for those. So that's kind of where we're getting started with in this new Red Book. So just the information, briefly, that financial information for a business is always summarized. We're still using the same procedures. We're still using generally accepted accounting principles when it comes to all of our accounting information. None of that has changed. Okay. So, like I said, here's that review of that accounting equation: assets equals liabilities plus owner's equity. And because we're dealing with corporations, we have the stockholders' equity. And so that equity, remember, is the value of the business. So that hasn't changed. So here it is again. So just so you guys can see, I'm sure you guys are like, oh my gosh, Miss Webb, this is like chapter 1 in the Green Book. Yes, this part it's like I said, it's going to be just like a quick review to get you ready and prepared to do some a little bit more complicated accounting. So source documents are still the same: memos, invoices, sales invoices, purchase orders, um, I think I said memos, receipts. Those are all still the same. We're still going to be using those different source documents. We still have our double entry accounting. If we have a debit, we have to have a credit. And we're going to be using those special journals: the purchases journal, the sales journal, the cash receipts journal, cash payments journal, and then, of course, our favorite is that general journal. So here you go. There's our, debit and credit, our our friend, our best friend. And then, of course, we have our accounts. So if you look at this slide, that is our T accounts. Those are the accounts that I had you guys put on your 3x5 card, right? So if you need to make another 3x5 card, make another one. You can, if you have some at home, you can make it when you get to school. But this is kind of where we're living at. And then we have our ledgers. So we're taking, that's where, we're taking all that information from the journal and updating all those individual accounts. So that's where our cash lives. All of our main accounts live in that general journal. All of our individual, like people and businesses, they all live in those subsidiary journals. So our controlling accounts are like accounts payable, accounts receivable, and that and so those are going to be those controlling those accounts where they all kind of live underneath. So here's just that example of the accounts payable ledger. And then they talk about, of course, file maintenance, which you guys already know that now that we're in, now that we're in that corporation, it's 4 digits, it's not instead of 3. So remember, you have division 1 is where it lives. So it's always going to tell us 1 is an asset, right? Category is kind of what category it is. And then the location is where it's going to be at. So in this case, this was a merchandise inventory, so it's in that 3rd category. And then where it's at, so it's going to be towards the beginning. I have some screaming at me here. All right, so let's see, where am I at? My PowerPoint. Okay. So now so that was like the review. So we're going to be using our what we call departmental accounting system to keep track of those purchases. So they're going to tell us what our categories are, and then we have to keep track. Did we buy in category 1, or did we buy in category 2, or did we buy in both? And then it'll have it separated. So this is an example of just a regular purchase on account. It goes in the purchases journal. Here it goes into my accounts payable, but then it talks about what category. So this is where it's important. Is it a category in my purchases? Is it a grill, or am I buying furniture? So in this case, up here, I don't know if you can, I'm sure you can see, but I don't know if you can see my mouse move. But under department, it says furniture. So I'm going to put that whole purchase into the furniture account. So here is that same transaction in a T. My purchases furniture went up, my accounts payable went up, and then of course I went into my subsidiary ledger and went to Backyard Furniture and put it into their account to show that they owe us. All right. So once it's done, we have to post. So taking that information from the journal and updating individually. Remember, we post individuals every week. We post totals at the end of the month. So individuals, so we'd go to Welby, that's why you see Welby. We'd post Welby every week. We post the totals to the accounts payable credit column and purchases debit columns at the end of every month. So that hasn't changed. This is all kind of review. Same thing, and then this shows us now it's the end of the month. Notice it's the 31st. We've added up all of our column totals, and now we're actually posting. So we're going to accounts payable. We're putting it into the credit column because the column says accounts payable credit. And then we'll do the same thing in purchases as a debit. So we just try and make sure that our debits and credits equal, because they have to. And then we have, and you guys have done this before, the purchase returns and allowance. So if we buy something and it's broken or it's dented or whatever and we need to return it, we have an account for that. So we have an account if we're returning whatever is in that department. So now remember, it's still all in department. So this one is a purchase returns and allowance for grills. So it's a grill cover. So this one, we have our purchase returns and allowance into the grill account. So our purchase is a debit. When we return it, it's a credit. So like I said, that hasn't changed. The only difference is now we're just making sure we put it in the right department where it goes. So here it is shown in the T counts, and then we're on our last part. So now we have our cash payments. So we might get a discount when we go to pay for it. So we purchased it, right? Now we're going to pay for it. They're going to give us that 2% in 10 days or 3% in 15 days. So this shows that first payment where we owe them the original amount, which was $920. They gave us a discount on our grill purchase, so the discount has to go under grills. And then we only paid them the $901.60. So they show it to you in the T account. And then they're going to talk about then they talk about the discount and then how do you calculate it. So let's say on this example, they have an original purchase. All right, for P670, we returned some of that. We returned some of that purchase, so we returned $182. So that left us owing that $642. That's where those numbers come from. Now, to figure out the discount, sorry guys, we take the amount that we now owe. So not the original amount. So we take the amount that we owe now. That's the amount that we're going to pay. They give us a discount of 2%, which equates to $12.84, and then we subtract that, and then this is the amount that we're actually going to pay. So it went from $824. This DM that's the debit memo that was recorded in the general journal. And so, and posted and already reduced from the account. And then we're going to pay for it. Then we're going to pay for just what's left. So hopefully, I didn't go over that too fast. Normally, it'll just be the original amount times the 2%. But this sometimes happens where it has that purchase return. So this is the transaction for it. So it's the 642, and then you have the discount for the furniture, and then how much money that we actually pay for it. So there it is in the T account form. So notice where it has the original amount on the bottom, where it's under Teton seating, the original amount for the 670 was 824. You see that DM on the debit side for the 182, so that means they took it out. And so all we owed was the 642, and since we paid it, that's the amount. Well, we paid most of it, right? Before the discount. So we're taking that 642 out. So we have to keep track of our cost of merchandise. I think we did a little bit of it, but we didn't do a lot of it. So this is our piece that we're going to talk about. So they give us all this information. This is not something that we have to, we have to calculate the ending number, but it's not like we have to come up with these numbers ourselves. They're going to give them to us. So our purchases, we're going to subtract out our discount and returns. Those two are added together. That's where the 7,000 came from. And then we subtract those two numbers, so what we bought and then what we returned. We subtracted those two out, so that gives us the net amount of purchases that we purchased for that, whatever that was. So grills, whatever. So they have on here, there's a couple of different methods that you can use, procedures. So it says some businesses elect to record the purchase discount when the purchase invoice is approved for payment. That's what they call the gross price method. And then, or they use it, or the amount is recorded to accounts payable as the net of the amount of the invoice and the purchase discount. That invoice is paid, the transaction's debits, and that's the net price method. And that's usually the one that we follow. That's the one that they teach in the book. So here's just an example of how to record a cash payment for buying merchandise in the cash payments journal. So buying supplies is the same, rent is the same. This is the example of buying that merchandise into our grills and then into a certain department in cash. And so the last piece, and you guys, this is the piece that you all love. I know you guys love petty cash. You're like, oh, let me make it rain. Yes, petty cash is the pain in the butt of everybody, I think, just because it is. So remember, petty cash, when we record it, we're only recording what we buy with the money. So if I have the $100 in my drawer, I only record in my journal what I bought with that $100. So did I buy supplies? Did I buy, they have advertising for grills. They have a miscellaneous. What did I buy with that? And that's what I'm going to record in my journal. So if you remember that, if you can remember that, I only record what I spend that money on. You will come around to the petty cash. You'll come around to it. So they just show that example. So in this case, they spent some of that petty cash on supplies, advertising, miscellaneous, and then they recorded it over in our cash credit. Because we're going to have to write a check to put that money back into the petty cash fund. So that's what it looks like in your T accounts. So posting Remember, individuals are posted weekly, totals are posted at the end of the month. So my Delmar Industries, my purchased furniture, those are posted individually during the week. My totals at the end, if you look on the 31st, my general totals, general debit and credit, have the check marks under them because I don't need to post those because those are the individuals. I just need to post the ones that have the column accounts. So like accounts payable, debit, purchase, discounts, credit, grills and furniture, and then cash. Those are the totals I'm going to post at the end of the month. So individuals weekly, totals at the end of the month. And like I said, that's not a new concept. That's just something that we've always done. All right. And guess what? Yay! We are at the end. So I'm going to try and get you guys set up in MindTap. We're still working on trying to figure out the situation. Your link is up in MindTap. If you remember last year how to create your account, you can try. If not, I will have your guys' account created by Monday when you guys get here. Hey, have a great weekend, guys, and you know what? Do something fun. Okay? All right. Bye.